Okay, so let's get started with episode 3 of the community session. It looks like Scott has joined. How you doing, Scott? So,
Testing. I'm good.
so I thought, I'm going to combine your suggestion and Kiter to look at utilities because what I showed up to the session with is an idea of, okay, let's think about what stocks are going to work for the remaining months of 2024 that are going to set up well for 2025. Okay. Technology has been really selling off. Technology sold off in the last month. If you look at my screen, it sold off considerably. And, is it going to recover? I think eventually it will, but I think we're in a pretty good correction. And this correction could continue on, I don't know, for a week, a month. The correction last year was, call it a month, maybe a little more than a month. And it was kind of like it would go up and down, up and down. It wasn't as jagged as this one. This one's been pretty, down days are down. The NASDAQ's been down like upwards of 3%. And the technology stocks tend to be really represented by the NASDAQ. Having said that, I mean, we could be in a technology kind of correction crash. If you look at NVIDIA as an example, it's down 25% from its high. So that is full correction mode. Once you're down 10%, it's classified as a correction. 25 is most definitely a correction. Now, the top performing one is utilities. So we'll take a closer look at utilities because that might work really well for 24 and maybe continue on through 25. And like you said, there is a scarcity of power, so to speak, or there's more people using electricity to cool their homes. You got data centers that are pulling power and drawing power to consume it. So there is going to be demand. So we'll take a look at utilities. And the other sector that's doing well, real estate. I think the drop in real estate, interest rates has made real estate companies more attractive. Okay, that's interesting. Healthcare. I think healthcare is going to work. And there's a couple reasons for it. And then the last thing I'm going to look at is some parts of financials are going to work. So my favorite category going into the back half of the year is going to be healthcare. And the reasons for it is that if you look at healthcare, if you look at the 5-year performance over 5 years, it's in third place out of all these sectors. Healthcare tends to be a good performing sector. And if you go into a recession, which we have a good chance of happening, that recession can happen, but people are still going to go to the doctor if they're sick. They're still going to go buy their medicines if they need medicine. They're still going to go, hey, heaven forbid you get a disease or an illness or you break a leg, you're going to go get healthcare. It's not like, oh, you know what? The economy's bad. I think I'll get my leg, fixed in 2 years. You may delay maybe some dental work or maybe some cosmetic stuff, but in general, healthcare tends to weather recessions quite well. So I like that aspect of it, and it tends to outperform other sectors that are safety stocks like utilities. If you look at the 5-year on utilities, it's only a 20% return. You look at real estate, similar. These tend to be sectors and companies and that pay dividends. So investors want an income out of these stocks. And if you're looking for income, those are great places to look. But if you're looking for return, I really like healthcare because you could find healthcare that is growing, appreciating, and you have some like Pfizer as an example, pays a really nice dividend as well. So you get the best of both worlds there. Then the last one, some pockets of financials, because as interest rates really drop, for example, the example I'm going to go through is you can really look at specific spots of a sector. For example, mortgage refinance or finance, excuse me. Now, I wanted to point this out because interest rates are really dropping in the United States. When that happens, people that have a loan against their home, they can go in and say, hey, I have a 7% interest rate on my loan. And right now you offer 5.5. I want to refinance. That creates a transaction for these companies, and they make money. They make money off that transaction. They also sell that loan. So that's always good. So, and then I've got a comment there. And Kiter, I'm going to read it in a few minutes. Help give me a few minutes to finish my thought. All right. So specifically, I looked at a couple companies that are mortgage companies, and to show you like a rate of return on these, I guess somebody figured out that Mr. Cooper is going to do well, and they figured it out a while ago. And the return has just been really good on this company. Part of it is they've grown really nicely in the trailing 12 months. So they're growing really well because people are refinancing, or maybe they're sitting on loans where, hey, I've got somebody paying me 8% on a loan, and now the borrowing rates are down to, for a commercial entity like that, maybe they can borrow at 4 or 5%, so that interest rate differential is really going to be positive for companies like Mr. Cooper. So that's somewhere where we can like start looking at, okay, are some of these stocks going to bounce back? And Rocket is the biggest company in this industry, by the way. And when I looked at them, I thought, hey, this might have something to look at, because they were gigantic. Interest rates went up and their revenues just collapsed. So their stock price also collapsed. And now the stock price has kind of just been bouncing around. You could say it's gone up a little bit, and probably over the last year, it's done okay. Yeah, 69%. That's better than okay. But you could see that it could really rise back to a really nice level of like $24 a share. Right now it's at 17. So this might still have some gas in the tank, so to speak, from a stock, and it'd be a stock worth looking at and analyzing. So that's like an example of, hey, looking at the back end of 2024, let's go find some companies that should be doing well. This example is going to be temporary, meaning lower interest rates are going to give them a boost of revenues maybe for a year, maybe 2 years, but then it'll go away. I come back to my favorite sector is healthcare, because healthcare is more consistent. We're going to need healthcare in 24, 25, 26, 27, 28. And it does weather recessions quite well. So let me pause there, and I want to get to a comment from N. Kiter, I believe. So I read a source that you trust that each inquiry to ChatGPT takes 10 times more than the traditional Google query. That includes direct and indirect, like DC cooling. Interesting. I didn't know that. That's really interesting to know. We'll look at utilities and kind of drill into that. So Scott, I have a 30-year fixed mortgage from 2016 at 3.25. Yeah, very good timing. That's why people are going to refinance, because if, let's say, they bought a home 2 years ago, or for some reason had refinanced 2 years ago, and they're sitting on a 7% interest rate, they can't wait to get to a lower rate. And now that interest rates are dropping, they want to go into that. And then Kiter, healthcare during COVID, people postponed their elective treatments. You're right. To some extent, I think we're beyond COVID, and I think people should be catching up on treatments and so forth. I just went to the dentist this past Monday. So I think people are catching up, and I think it'll continue to be the case. We'll see. But that's exactly, the kind of stuff that healthcare takes care of. Talking healthcare, how is J&J in your opinion? Recovery play. Yeah, let's take a look at J&J real quick. I think that's a good idea. So J&J is Johnson & Johnson. And this historically has been one of the better companies. They have a great credit rating. And if we look at their stock price for the 1 year, it's down 3% year to date. 4.59. So it isn't priced up. Like, let's say you looked at Meta or some other stock, they're pretty priced up. It's a big cap, 395 billion. It's a well-diversified healthcare company where they do as simple things as Band-Aids up to things that you'd find in a surgical room and things of that type. They also do drugs, pharmaceuticals, and that kind of thing. So this is a very well-known company. They pay a dividend of 3%. The PE is really low, 10.9. Incredible. And if you look at their growth, they grew.
I'm calling them. I'm calling them. Sorry to interrupt. I'm calling them the recovery play because they are suffering from the Talc disaster. I believe but I think that they are coiled spring, in my opinion.
I would agree with you conceptually. Yes, I would agree with you. And you're seeing that, like Enkider was talking about, we hit COVID, right? And for some reason we're missing 2020. I'm not sure why the data is missing 2020, but you see how it's slow, and then it actually went negative in 2022. Maybe that's when, people didn't want to go to the hospital and get elective surgeries and all that good stuff. So they had a lack of revenue, but now they're beginning to pick up. And let's look at the quarterly. And if we look at the quarterly, they're growing. So that's really good. So that most definitely, it's a recovery play of the healthcare space, a Johnson & Johnson company. On top of that is with the employment data that we got yesterday, or the payroll data that we got yesterday, there's a pretty good chance we're going to go into recession. If we do, you got to, consider, okay, healthcare companies are probably going to do pretty well compared to others that are really dependent on growth of the economy. So it's a really nice idea, Johnson & Johnson. When we look at their free cash flow, I think they cash flow quite well. I haven't looked at J&J in a while, but here we are. Almost $20 billion of free cash flow. Very good. And you see how they've just been consistent at growing their cash flow. Probably a few years ago, J&J had legal problems. If you remember, they had a big class action lawsuit around the talcs that they would they sold for a long time. They're so fine that they would get into people's lungs, and there was a big class action lawsuit. I believe that's behind them. You want to make sure you do your homework on that. Make sure there's no class action lawsuits that are going to come up, and they're going to have to pay, billions of dollars on. So the cash flow is really good. It is a big cap. It's 400 billion. That cash flow, if they're a growing company, I think you could substantiate the market cap, but I wouldn't think you're going to double your money on this in the next 5 years. You're probably going to make a good return, 10% or so, maybe 15. And then you got that income out of a nice stock. This is one of the most trusted brands in America, Johnson & Johnson. They have a great credit rating. So that's a really good idea within healthcare. If you want to analyze companies like this and see which one is the best one for your portfolio. So we're talking about, stocks and sectors that are going to play really well for the remainder of 2024. Healthcare, good example, Johnson & Johnson. We talked about an example within finance. I think you wanted to go into utilities. So let's go talk utilities. And what I'll do is go into utilities. And here's the 109 stocks from the biggest market cap to the smallest. And utilities, I don't invest in utilities a whole lot because they spend so much capital in their operations that they tend to always have like negative cash, which is amazing that they always have negative cash flows. I'll give you an example. Let's go into Duke Energy. Duke Energy, we look at just really quick. I'll make the point. When we look at free cash flow, it's negative. So you think about that. Why is it negative? Well, free cash flow is a simple equation, which is you take cash from operations and you take away capital expense. And the cash from operations is less than the CapEx. So here's cash from operations, okay? And then CapEx. So kind of making sense of it within the industry, that means that these power generating facilities, power plants, they consume so many parts and they have to replace them. The people to manage these things, you need to have a lot of people managing them. You have transmission lines that fall down, they have to be repaired, or you have to do preventative maintenance. You have to, there's big windstorm and power lines are knocked down. These companies have to replace that kind of stuff. So that's been one of the reasons why I really haven't bought into utilities. Now there's a big macro change, a big causal effect, which is data centers are consuming a lot of power. It's interesting that you read that AI consumes like 10 times as much power than a Google search if you use Chat GPT. I had never heard that, but it probably makes sense because all I hear is that with the data center build out for AI comes a big need for electricity. I've heard that many, many times. So that totally aligns with your comment, Nkiter. Now, do I think these guys are going to create more revenue? My answer is yes. But the other thing about growth, right? If you ask Meta, right, they do Facebook and Instagram, WhatsApp, and they do Meta AI. They do Threads now. And you said, hey, Meta, we'd like to put 20% more people on your platforms each year. They'd be like, no problem. We're going to put more servers in line, but the timing, the amount of time it takes to do that for Meta is almost instantaneous. Not a big deal. Is there a cost? Yeah, they have to put more servers, more capacity for Facebook to handle more users, Threads, and so forth. But it's quite easy for them to grow. It's quite affordable. Power plants, not so much. It's like, hey, Duke Energy, you're producing, 10 megawatts. I have no idea how to measure power, by the way, but you're doing like 10 megawatts in let's call it the Southeast. And that market now needs 20 megawatts. Can you get that to us by the end of the month? The answer is no. To build the power plant takes years, 5-10 years. You have to have approvals, regulation. You have to build it very safely. You have to procure components. You have to procure land. You have to set up the grid. I mean, it takes 5 to 10 years to get anything done that you decided on today. So if the data centers are knocking on the door of Duke saying, I want more power, Duke can want to sell them more power, but can they sell them more power? Because do they have the capacity to provide more power? That would be my question to you. If you're going to look at utilities, I get the demand side that there's more demand for power, but how is the industry going to provide the power? Because it doesn't count if they can't provide it and sell it. So that's my point there. I'm shorting a power company. I think it's Vistra. I think I'm up on that short position. And utility companies have been really priced up because there's a big expectation that these utilities are going to be worth so much money. They're going to be building nuclear power generating facilities everywhere, and it's going to be great. So I'm up 10% on Vistra, even though Vistra rallied because they got some good news because power is selling at a higher rate. But if you look at like Vistra as an example, this stock is really, really expensive. Look at the chart on this. It's up 231%. This is a utility, okay? And you look at their financials. Are they growing 100%? Nope. It's pretty flat. Even if they were growing at 25%, I would question this valuation. It's like, how did they go from being valued at around $20, $22, $25 a share? And now they're valued at one point, they were valued at $100 a share. That's just a frenzy. That's just a lot of hype. So I started shorting this stock and I'm up 10% on my short position. I think overall, this is going to come back down to about $40 a share at some point. because that's where it really should be. If they're really optimistic about power generation, maybe $40 a share. But for it to be at $72 a share is really exaggerated. So utilities, I think, could be a good place to weather a downturn, a recession. You can also play off of the additional demand from AI. But I would just put my thoughts out there saying that, hey, there could be 20 times the demand for power, but if they cannot produce it and sell it, what is it? It doesn't count. They're not going to generate their revenue. They're not going to generate any of that. The other thing too about power generation is utilities are regulated in the US. And for the most part, they're regulated for the consumer. They're regulated for people's homes because they don't want, let's say, somebody on a fixed income that's retired and they are accustomed to paying, let's say, $100 a month for electricity. And all of a sudden it's kind of a free market. And they're like, well, we want to sell it to you for $1,000 a month. And this fixed income, consumer is now unable to afford power. So they regulate it so that they can only have increases in a measured way to the general population. On the commercial side, there's two things going on. First, smart businesses will get into long-term contracts to procure their power, and they'll have a per kilowatt rate that they'll buy power. One of the jobs that I had way back when I was with a pharmaceutical device company, I did negotiate the power contracts, and we would get into 5 or 10-year contracts to buy power. So the smart companies that got into contracts, they're not going to be affected by this rising power cost. It's those new businesses that have to buy new power that will have to pay the higher rates. So there's just a lot of stuff going on there. I would just encourage you to do your homework, go into it eyes wide open. You will get a good income out of utilities. Let me go back to Duke because I think they probably pay a better dividend. So Duke Energy pays 3.67 over the last year. It's up 23%. So I mean, this has been a solid return. 23% appreciation, and you get paid a dividend. That's a solid return. So I like where your head's at. Just go into it eyes wide open, do your homework, as I'm sure you were going to do. So we talked about utilities. Good idea. I like that. And let's keep an eye on it. Let's see how that plays out. I'd be very curious to see how it plays out. So the other area that we talked about was REITs, real estate investment trusts. For a income investor, somebody who wants income, those are really good options. And before I jump in there, I think I need to catch up on some comments. So Scott, just FYI, fission is splitting the atom. How current nuclear power plants work. Fusion is how stars work and is the future of nuclear energy. I studied physics. Awesome. Very good to know. And I happen to think, in the United States, for whatever reason, the general public was afraid of nuclear. I got familiar with it and realized that nuclear power is not that dangerous. And some countries like Japan and France, they generate most of their power with nuclear, and they don't really have incidents, negative stuff. Yet here, like in the US, we're willing to burn coal, pollute the air, and then everybody suffers from that pollution, but we're afraid of nuclear because it might cause a bad outcome. We're willing to commit to a bad outcome that we know, kind of like the devil we know, and burning coal and so forth. So I'm for nuclear. I'm good with that. And hopefully they build more nuclear power plants, but those just take a long time. I don't know what the ramp up or the time it takes from the time you say, hey, I'd like to get a nuclear power plant. It might take 10 years. I mean, it takes a long time to build a nuclear power plant. And I think we should get started. I think some are going to come online and hopefully they get built. So Dumitru, I hear more being said that the next recession is going to be debt-related financials. I saw some huge numbers of banks' high unrecoverable debt. What's your take on that? Yeah, so I think the consumer in general, and I'm going to make some big kind of like observations. And I think every like little pocket of financials would be probably a little different. But I think the consumer is in decent shape. And here's my rationale is during the COVID years, the government sent people money and savings rates are really high compared to historical levels. So people have money in the bank. Second is a lot of people were asked to work from home. So their expenses went down. They didn't have to, as an example, get dry cleaning taken care of, buy new clothes to go into the office and look professional. And they didn't have to drive their car and burn petrol or gasoline. Just a lot of the expense of living and working went down. So the consumer, I think, is in decent shape. Now, are they over leveraged? I think the car business is a little over leveraged. Car prices went through the roof. So I think you are right that in that area, I would be concerned. But I don't know that credit card balances are extremely high. I think we're okay there. I think you should kind of take it industry by industry and specific finance company to specific finance company to see how much risk there is. But in general, I think we're okay. If we go into a recession, I can't say that it's going to be a very deep, painful recession. The deep, painful recessions are usually caused by something that broke in the economy. And the last real deep one we had was when we had the subprime mortgage meltdown in the US. That's where, for a long time, lenders of real estate were qualifying people that had a very risky credit rating, that really mathematically they couldn't afford a house they were buying or a loan that they were taking to buy a house or refinance. And they were pretty much tricking these people, unfortunately, by giving them adjustables that, for the first year, maybe your payment was $1,000, but then once the adjustable period wears off of a low entry rate, a teaser rate, then it would go from paying $1,000 mortgage to $4,000 or $5,000. And that household had no way of paying that kind of amount per month. So very quickly they were like, hey, I can't pay this. You're going to have to take this house back, to the point where there was a glut of a lot of homes being repossessed, and it kind of broke the mortgage industry. And then people on Wall Street collateralized all this debt and said, we're going to make all these instruments that then insurance companies are going to insure. And a lot of industrial investors bought into, and it just kind of broke the economy. And it took a long time to get out of it. That was a deep recession. I'm not seeing anything like that. There's nothing like, oh man, something's going to break and it's going to be really deep. I think it's just going to be kind of a little bit of a COVID hangover. It's like, okay, we had COVID a couple years ago. That was a big bummer. We had a lot of people die, which is very sad. And now we're back into kind of like more of a regular kind of economy. And we're back to living more normally, kind of like in 2019. So I think if we have a recession, I think it's going to be shallow. It's going to be not heavy job losses. No one industry, I think, is going to get hammered. I think it's just going to be a light recession. It's my expectation, but we'll see what happens. So Dimitri, also Germany has shut down its nuclear power plants by 2023 due to its older commitment for green and safer energy. Cool. Well, I hope they can get enough, power out of solar and wind. That'd be awesome to see that, because I know I got solar panels installed on this house in 2022, and we're saving $100 to $150 a month in dollars, and we're going green. So we're producing all the power that we need for our house with these solar panels. So that's pretty cool. That's really cool. Can you please look at NVO, LLY, and CBS? I'd be happy to. Let's let me write those down so I can move off that screen, but I'm gonna look at all three. LLY and CBS. And then the last comment before I turn my attention to, two more comments, excuse me. Do you pay the broker fee interest for short? Also, do you pay dividend in any? The CBST pays 2% dividend. All right, so good question. So I'm not a big short seller. I'm more of I like buying companies. I like buying real estate when it's really low priced, and then I make a good investment. Now, I noticed that the market in some ways is super overpriced, semiconductor being the number one suspect on that. And I decided I'm going to short, beginning with NVIDIA. And then I shorted like 6 other companies, or 4 other companies, excuse me. I already sold CrowdStrike, and I made 29% on CrowdStrike in 10 days. So when I reached out to my broker, and I have a couple brokers, but the one that has no interest rate on margin is Fidelity. And I said, hey, I plan to start shorting a few stocks. Let's go through what it costs. And they said, hey, if you have enough cash, no interest paid on a short. Now, you have to buy shorts on margin. But if in my broker's case, if you have the cash, you're essentially borrowing from yourself. You're borrowing the cash that's involved from yourself, and you're buying on margin. And I pay no fees that way. The question you have with regards to the 2% dividend, no, I don't pay a dividend. That's the company that decides with the cash we have, we're going to pay a dividend. In my case, the way a short works, you probably know, is it's almost like I take 10 shares of VST in this case, and I sell them, and I get that cash, but then I owe those 10 shares. I borrowed the 10 shares, and I have to come back and buy 10 shares just to get back to zero. So on all my short positions, I will have to buy shares, and I will have the decision to make on all these shorts. Right now, I'm in the green on all my shorts. Great. 2-3 weeks ago, I was in the red on a couple of these. Our friends over at NVIDIA, that stock was just going crazy. The one that's doing the best right now is Super Microcomputer. I'm up 22% on Super Microcomputer. I put the number out there of 30%. If it gets to 30%, I'm closing out that short position, taking the money and running. Or if I lose 30% on a short position, I pay the market and say, thank you for the lesson. I was wrong, and I'm paying the price. Okay, so that's how I'm going to operate there. So thanks for the question there. And then what's your take on NEP Clean Energy? I think I've looked at those right after we get done with these other symbols that I already said I would cover. Let's take a look at those real quick, and I'll let you know what I think. Germany's green energy percentage stands now at 46% with a target of 80% by 2030. Way to go. That's awesome. That's great. And, again, solar power, my education is in accounting, finance, and then I have a master's in business. So really, I don't get into the science of power generation because I don't have the education or the experience to do so. But from just an average person or maybe educated person's perspective, when I shopped for solar 10 years ago, it was like we had to cover the whole roof with solar panels, and we still didn't generate enough power to satisfy our needs. Fast forward, the panels are so much better. We only covered, I would say, about 20%, maybe 25% of our roof. We live on a single level home, and we generate all the power we need. That's great. That shows innovation in the space, that solar panels have gotten better and better and better and better. And they've gotten better because people have decided to get solar panels, and companies have decided, hey, we want to generate the best solar panels because there's a good market for them. So all that's good stuff. I hope Germany is really successful in that. What's your take on Micron? Given all the tech, yep. So I think Micron is going to follow the footsteps of Broadcom, and Broadcom is down quite a bit. It's going to follow. I think NVIDIA is different, right? NVIDIA is very different. NVIDIA is kind of like the solid gold stock in semiconductors. That's still down 25% from its high. But I think it has dragged a lot of other companies or just companies that are in the space up to new valuations, and Micron being one of them. I think Micron might have trouble sustaining their stock price. So that's my opinion on Micron. Okay, so let's take a look at NVO. So, okay, this is a pharmaceutical company, Novo Nordisk, and engages in research, development, manufacturing, distribution of pharmaceutical products. Familiar with them. I think they're doing well. So 429% return over the last 5 years, or last year up 62%. It's very good. Very little dividend, probably because the stock price has been just going up so much. Their growth has been excellent. Look at this growth. Beautiful. And this might be one of the companies that has the weight loss drug. I know Eli Lilly is one that does have that. But these guys, I think, are clicking. They have really good drugs that, people need because they have an illness that this drug helps them with, or a condition. Or B, I think they might be the weight loss. They might do weight loss. Yeah, obesity care. Diabetes and obesity care. So that's the segment that's super hot in healthcare is the whole, they call it diabetes and obesity care, but I think a lot of people are using it for, hey, wouldn't mind, losing 20, 30, 40 pounds, and they get on this drug and it helps them. So there we have it. So this is a good company, good growth. It is expensive. And I think it, I did not catch the weight loss, trend. I missed on Eli Lilly and I missed on Novo, excuse me. But it might be a little late, but I could be wrong. I think other pharmaceutical companies are now trying to introduce their weight loss drugs. We'll see if there's more competition in there. This company has had very good return. Looking at the other names that you put out there, I think you went LLY. Eli Lilly is the biggest market cap in this space, $764 billion. They are the leaders in that weight loss drugs. They've done really well. And their growth I don't see it as good as Novo, which is interesting. They generate great free cash. They got to this valuation because they frankly are just killing it and doing really well with their portfolio of drugs. Look at the stocks up 652%. Incredible. So way back here, they were probably looking up to other companies like Pfizer and Merck and Bristol Myers. And over the last 4 years, they have just gone on a run because they had the drugs that the market really wanted. So you just looked at two of the most desirable companies, but investing is about, it's great that they've done this in the past, but will it continue to drive that type of success? The PE ratio is 118, and this is a big company, 36 billion in revenue. So can they double that number? I don't know. That's going to be hard. Forward PE is 54. So you're paying a really expensive PE. You're paying an expensive amount for a stock. And if Eli Lilly keeps doing really well, it might be like an Apple-like stock where it just stays and continues to appreciate at a really consistent rate. But I would also say that these types of stocks, if there is more competition with the weight loss drugs, maybe entering the market in a year, these guys are really going to feel it because right now they're charging whatever price they want, getting really good margins. If more competition enters the market, that would take away a lot of their margin. So that is Eli Lilly. CVS. CVS is a little more of a value investor stock. Year to date, it's down 25%, 22% over the 1 year. Over last month, it's up 3%. And they're going to announce earnings this week. So it'll be interesting to see what they say. They are a growth company, and I see your question, and Kidder, give me a second. They continue to grow their business, but the market continues to sell them off. And I think that the market believes this business isn't going to work, which is retail combined with their healthcare payer, and they're also a health services provider. So they're kind of a vertically integrated business. I happen to believe in the company because what I like is they're growing and they continue to generate really high free cash flow. So I own shares of CVS and I'm carefully adding to my position. And I'm going to be very interested in their earnings on August 7th. So, and Kidder, did you have a question you wanted to ask?
Yeah, it's actually a comment about Lilly. They are in high valuation, but they are also developing Alzheimer drug. And I think that the market is waiting for this to be the next blockbuster for them.
Yeah, it could be. That's, the value of a pharmaceutical company is the drugs you create and the demand for those drugs. If they have an Alzheimer's drug that is effective, there's big demand for that. So if it works and they get FDA approval, look out. I think it could really, really work for the company. One more point on CVS that Mike commented is, he loves CVS. They pay a really nice dividend. So again, we're going into a period that I think the expectation for recession is much higher. And you have this company that's just a big part of healthcare. They do $360 billion in revenue. And you're buying the market for you're buying the company for $74 billion. Their PE is 10.4, forward PE 8. You talk about a discounted company. Analysts say it's discounted. It's a buy. I believe it's discounted. I'm buying because you are being paid a nice dividend while you wait for the stock to start working. Now, CVS, its main competitor is Walgreens. Walgreens has been failing and they've had trouble. They also have a competitor that's in bankruptcy, Rite Aid. So when competitors go bankrupt, that's a good thing for the company that continues, CVS in this case, because they're going to have one less competitor. Or Rite Aid's not going to be able to grow. In fact, they're contracting because they're so strapped for cash and capital. They can't open new Rite Aid stores. They're closing stores. So where they close a Rite Aid store, all of a sudden, the store sales of a CVS just really went up. So I think CVS is really trying to break out of just being a retailer within the healthcare space and a really effective one, but they're trying to break out by being a healthcare payer, being an insurance company that pays, that people buy policies with, and then they're a healthcare payer, very cash oriented business. And they also are trying to be a health services provider, which could really bring in added revenues and overall, I think, bring better margin to the company. So I like the move on CVS. I'm going to continue to own that stock, especially as we head into recession. So let's move over to NEP. So that's NextEra. And I think this is a $2.4 billion company. This company, clean energy projects, okay, in the US. All right. And they're about a $1 billion company. PE isn't bad, 8.1. Very good. Forward PE, 13.5. Wow, look at this dividend, almost 14%. So what is going on? Wow, it's down 50%. Okay, let's sink our teeth into this one. Why are they down so much? So we look at their financials. They have growth, and the quarterly looks okay. It's not the biggest utility company you've ever seen. Okay, that's fine. They have grown their revenue. They're operating. I think I'm still on the quarterly. I'm going to change the annual. And are they profitable? So they lost money in 23. They made money in 22. And they made money in 21. The trailing 12 months, it's getting a lot better. You see that they lost a lot of money in 23, but it's really changed. And now I want to go back to the quarterly to see what the quarterly looks like. So pre-tax income. So they are making money in the two most current quarters. Okay, so the business is recovering. And I forgot to check one thing on revenue. So the revenue June compared to June of last year, you had good growth. Very good. Okay, I like that. Growth, and they're profitable. Let's take a look at cash. So cash flow from this business, free cash, 162, 14. Okay. And you see how these guys have cash flow, positive cash flow. I showed you Duke, negative cash flow. These guys are positive. So I'm beginning to fall in love with these guys. I'm simple. I like good numbers. I don't want flowers and chocolate. I just want really good fundamentals. And NextEra looks interesting. So they have 160 million in cash. Multiply that times 20, you get to about 3.2 billion, and they're at 2.4 billion. They are growing at a very good rate. So this is a company that I'm going to do more homework on because I'm not in this category. I think it's interesting. I'm seeing fundamentals. Let me look at the balance sheet because that could be a showstopper. And I'm going to go straight to, I compare debt to EBITDA, and that tells me, so that is one problem. Debt to EBITDA is above 3. So I need to know, how are they going to get below 3? Is there a plan to do so? And I'm going to take a look at their balance sheet real quick. And I see your question, and Kiter, give me a few minutes here to finish my thought, and then we'll turn to your question. So we look at cash. Cash has been good, going up. Where's the debt? Now, here's why short interest rates are really important for a small cap. You see that they have debt here, and it did go down for current, and you have long-term debt. Well, in about call it 2 weeks time, the interest rate changed on this debt, if they can renew it or refresh it, by, I don't know, 1%. And 1% on $5 billion is going to be about $50 million of interest expense that they're going to save just because interest rates move down. That's why interest rates are so impactful to a small cap. So the good news is they're bringing their debt down. So I'm going to do more homework on this. There may be kind of an exemption that I would make of violating my debt to EBITDA has to be 3 or lower, because I am liking the rebound story with this stock that, hey, they've been sold off, but why is it? If they're generating revenue growth, profit, free cash flow, what's missing here? So I'm going to do more homework on it. Thanks for suggesting it. So my conclusion is this is an interesting stock. I'm going to do more homework on it. Now, Kiter, you had a question.
Yeah, thank you. Regarding NextEra, I see that it's limited partners. So I just want to hint about that. This is maybe some of the reason for high yield. But there are tax implications, as far as I remember. And I remember that I bought once, and if it is in a regular brokerage account, it's a big headache. So I personally, maybe not rightfully so, but trying to avoid limited partners because of the tax reporting and kind of complexities.
Yeah, thanks for bringing that up. I did buy a limited partnership a ways back, and I agree with you. It was a pain in the neck on tax time. They're treated almost like you're a part owner, and therefore the distributions that you get from the company in the form of dividends are treated almost as like they're like long-term capital gains versus short-term capital gains, which is positive. But man, I think when I did my taxes like 2-3 years ago, when I had that limited partnership, I think it took an hour to 2, maybe 3, just to figure out that was limited partner. It was a pain in the neck. And thanks for bringing that up. I didn't know that this was a limited partnership. I don't own any And
I'm not sure. I'm not familiar with them. I'm just looking at the name that you are showing in your computer. Like you see Energy Partners LP, which is limited partners. That's why I'm saying.
and what I would, the additional thought that I have is if they're an LP, they're going to have limited upside because the apprehension you have, other people have, other investors have. So it's not going to be like Meta that, oh man, it just goes up and the stock price goes up because the revenue is growing. No, there's kind of a low ceiling on limited partnerships. They're probably going to pay you good dividends, but they're not going to appreciate a whole lot. And I'm not interested in that. Yet another comment?
No, not for me.
Okay. All right. So, and then I think we looked at NextEra. No, so NextEra, is this a limited partnership? Did we look? Is it the same company? NEP and NEE. So NEE through subsidiary. The company generates electricity through solar, wind power. Okay. Okay. So this one is a full company. I don't believe it's a limited partnership. When we look at the stock price here, it is up 11%, not too crazy. And it's up 50% over the last 5 years. Very good. I mean, if you're owning a utility and you're up 50% and they pay a dividend, I think most people would be happy with that. The company has a PE of 25 and a forward PE of 23. Year to date, up 30%. Last month, 11%. These guys are probably getting, bid up because of the whole, AI hype and hey, we're gonna need more power for AI. So it's the stock's a little bit expensive, but not too bad. When we look at, see their trailing 12 months is down. So we have a company where their last quarter that was closed on June 30th was 17% less than the year prior. So that's a concern. Why is revenue coming down? That's interesting. And then the quarter before, revenue was down 14.6%. So those would be very important question marks that have to be answered. Like, what's going on? Is this a trend where it's just going to keep losing revenue? And that's a big problem. Interest expense, 820 million. So they are profitable. That's good. But the profits did come down. The compare was really tough, but profits are down a bit. Free cash flow. So negative, 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 negative. I don't like that. And it's probably caused because of CapEx. Once you get cash from operations, but then you have to look at here's operating cash flow. And then the company says, oh, but we got to repair the power plants. We got to put new components in there. We got to fix power lines and stuff. And at the end of the day, free cash flow is what's supposed to flow to either buybacks, dividends, invest in the business. In this case here, it's like, well, you have to put more money back into the business than the cash you generated, which to me on principle, I'm like, I don't want a business like that. So this one here doesn't pass my initial test. I'm not really that interested in it. But thanks for asking. I think we've been talking utilities and we've kind of drilled into them. So it's good to see a couple of examples. So, all right. So we've got through the list here. Let me see if I've got some comments that I need to catch up on. So Pat Harvey, thanks for joining. I think you asked to join last night, this morning, and you're on. So thanks so much for joining. Mike, I've made a lot short-term buying, selling NEP. Very good. Timing to collect dividends. Cool. And then Pad, general question, do you prefer to sell the loss and buy a lower price, averaging down? I'm struggling to choose any words. So just be careful with the in the US, you have wash sales. So you have to exit the position for 30 days before you can come back. So be aware of that if you come back within 30 days, you may have a wash sale, which means your basis is still going to be the old basis. And that would stink. Toward the end of the year, if I have any losing stocks, I try to take tax advantage of them and I sell them and then I stay out for 30 days and then I come back. So be aware of that. All right. So NextEra Energy is a growth-oriented limited partnership formed by NextEra. Got it. Okay. Good to know. If you have time, asking to review MDT. Let's take a look at it. MDT. And I think this will be the last one. Medtronic. I am familiar with these guys. So Medtronic is in the med device space. I call them med device. They do systems and stuff for this particular segment of cardiovascular pacemakers and so forth. Over the last 5 years, down 19%. Over the last year, down 4%. Year to date, flat. And the month, 5%. So it's beginning to rally. Might be a good time to take a look at this. Nice dividend of 3.4 if you're looking for income. $32 billion in revenue, market cap of $104 billion. This is a recognized name for me. I mean, I've known of Medtronic for a while. When we look at their revenue, they are growing. The most recent year, they grew 3.6%. They are a pretty good sized company. And then 3.64. The free cash flow from the company is 5.2 billion. They are growing slightly. It's healthcare, med device. So I could substantiate this number. It's not going to be like a home run type of expectation where, oh man, this is a $200 billion market cap company. If these guys continue to grow, yeah, absolutely, they can go to 200 billion, but they're going to have to start growing much faster. If you're just growing a little bit and kind of going down a little bit, I think you're going to be kind of potentially a value trap, and you're going to kind of just hover around, around this stock valuation for a while. So this one here, I don't know enough to know that, hey, they're coming out with a new product that's going to be exciting. It's going to grow their revenues by 25%. I don't know anything of that because I'm just doing a quick, review of it. But if there's something like that, that'd be interesting. This is a solid company. Their debt to EBITDA, let's take a look at that. Make sure that's not a liability and that it's okay. Debt to EBITDA, right at 3. So they're fine there. Operating cash flow. So here in stock analysis, it gives you a nice breakdown of free cash flow. You start with operating cash flow minus CapEx, and you get to your free cash flow. So this one's okay. This one's okay, especially as we enter a recession. This might be a good place to collect an income in that dividend, and might be a good play for an income investor. So thanks for asking about that. That one was interesting. All right. So got to run a birthday celebration. All right, cool. Have fun, man. Have fun. U.S. banks experiencing rising unrecoverable debt. Oh, very interesting to see. See if I've got. So I'll take a read here and I'll see what's in here and see if it is something that I got to consider. Thanks for bringing that up. So overall, Federal Reserve Bank of New York has highlighted a concerning trend, noting that the U.S. household debt reached 17.69 trillion. Interesting. Yeah. And, it's kind of like, which report are you going to pay attention to? I've also read that households are sitting on a lot of equity in their homes because homes have gone up so much in value. So there's a lot of money in equity in homes. Lower interest rates, people might be, hey, I'm going to refinance and pull 200 grand out of this property. I'm going to refinance and maybe have a line of credit. So that would be interesting to see if that's part of this article, if that's going to be part of the discussion, because I heard a different report that was pointing to that there's like household savings, if you include real estate and typically a family owns their house, there's a lot of stored value in that house. But I'll read that. I really appreciate you bringing it up. Maybe it's a blind spot for me, and I appreciate you bringing it up. Pat Harvey, look at Uber, Airbnb, if you have time, please. So considering that Uber and Airbnb are two of my favorite stocks that I own, let's do it. So Uber is, in my opinion, one of the up and coming, potentially one of the big, massive technology companies. This could be, if they continue to execute really well, this could be like the next Amazon, where they do a variety of things and they just do them really well. Ride sharing, they're dominant. And ride sharing has turned into food delivery, and they're also doing other categories within that space. What I love about Uber is they don't have a lot of capital that they have to put back into the business. If tomorrow 1,000 new drivers come on the platform or the network, Uber bought 0 vehicles. It's all those little micro entrepreneurs that want a gig, and they get their car, they get it certified by Uber, and they start driving. So that's a very scalable business, the whole sharing economy. That's why I really like them. Over the last year, they're up 27%. Over the last 5 years, 36%. The market really sold these guys off. So buying in this range, which I did, I thought it was a good idea. After they sold off, they IPO'd in 2019. I thought at the beginning, they just didn't have enough cash generation. They started to turn a profit. I think in the 22 era, I started to buy. Now I've got a pretty sizable position of Uber. I think I have, and Uber is classified as an industrial, by the way, and it's in the transportation industry. But I've got $59,400 of Uber stock, and it has had a pullback. I've been buying into these pullbacks. Now, Uber, I put in the category of they keep getting bigger and stronger and more valuable. Their growth rate's going to slow down because these numbers are getting big. But as long as I see them strategically keep getting better and better, they're going to keep absorbing and disrupting more industries. They're also growing internationally. So I really like that about them. They're probably valued fairly. If you look at their valuation, if you look at my valuation, they're valued fairly. But I'm buying on the principle that I do want to own the leading ride-sharing company that could potentially, like when you do the whole self-driving car thing, if it ever comes around, if AI ever delivers that, Uber is going to be sitting pretty because they have the clientele. So they could have a fleet of self-driving cars, provide rides for people. So that is a great opportunity. So I really like Uber. And if I take a look at my intrinsic value, I could share that with you real quick. And so Uber, and let me update, the stock price is $58.99. So, I mean, not a giant discount. There is a small discount, but overall, and this is with a pretty high discount rate because they are a riskier company. They're smaller. Now the interest rates are dropping. I might drop that 8 to 8.5 and make this valuation even better. But I like Uber. And then the other company you wanted to look at is Airbnb. Airbnb is one of my big bets, especially since they are a newer company. And so why did I invest so much in Airbnb? Right now, my Airbnb investment it's substantial. It's like 100 grand. Is that I bought properties in 2010. I put 2 of them on a short-term rental program. Airbnb was the principal company that would bring reservations to us. We were in the black on those properties. They made a lot of free cash. Then we sold those properties at a big gain. But I had the experience as a property owner on Airbnb. I've definitely have traveled on Airbnb for 10 plus years. And it's a really interesting, fun experience. You get to rent from other owners of properties. Scalability. So Airbnb could potentially be the most powerful real estate company that doesn't own any properties because they have access to all these privately owned properties. And now all these commercial property owners are putting their stuff on Airbnb because they see that this platform really, really works. And it is a true sharing economy business. So their scalability, they can double in size and not have to buy one property. That's very powerful. That's why I own Airbnb. And they generate great free cash. They generate awesome cash. For a young business to generate cash, it shows you how lucrative their business is. So this business hasn't been around for 15 years, maybe around 15 years. They've been public for a couple of years. So Airbnb is one of my big bets. When we look at them on stock analysis, just the growth is really good. Now they hit COVID, right? COVID had a little problem with travel. So that's a pass, right? I give them a pass on this year. But these other years, look at this growth. Great growth. Awesome growth. They grew this quarter. The stock sold off. Now, they did what Intel should have done last week or a month ago. They told the market, hey, guys, we're having a great year. We're having a great year. But we're going to have a headwind in Q3, which is the quarter we're in. Because I think there was some timing. But the quarter after that, we're just going to kill it because we have the Olympics and they had some other events where they feel that's just going to, they're going to destroy their earnings. I think in Q3 is what they said. And the market sold off because they're kind of nearsighted. And I've been buying Airbnb stock because it's been selling off. Overall, it's been a winner for me. I didn't buy when they IPO'd. I waited for the stock to come down. And I'm sitting on a very good gain of Airbnb. I just really like the business. I think Airbnb is the leader in their space, like Uber. I like buying leadership companies because they tend to dwarf into monopolies. And once you dwarf into a monopoly, you are really making a lot of money and you're very powerful in that industry. So I like Airbnb. Thanks for asking about those two companies. And I am gonna politely end the session. I think we've been going for about an hour. It's been a really good session. A couple of last comments. Yeah, Buffett's been selling his Apple stock. He sold like half the position. That's huge news. If I'm not in Apple right now. I made some money on Apple. I made like 16% in 2 months because I bought in a low just recently here in 24. Then I sold. I said, hey, you know what? I'll make a quick 16%. Thank you. And I sold my stock. But I'd be nervous if I'm an Apple stockholder that the Oracle from Omaha is unloading his Apple shares and building up just a huge war chest of cash. Isn't that incredible? They got $277 billion of cash. Incredible. And Berkshire is going to announce their earnings on Monday. We'll get more details there. So that'll be really cool to see. Hey guys, thanks for joining. You guys had really good questions. I think we had a really good session. Really appreciate all of that. Let's do this again in about a week. And as I go away, let me remind you tomorrow, I'm gonna join forces with Scott's Due Diligence. He's brilliant with his valuations. I think he has a lot to say about stocks. It'll be interesting to have a live stream with him tomorrow. It'll be at noon Pacific. And, we're going to probably talk about where we're at with this, correction in stocks. Love to hear what Scott has to say there. See how he's viewing the next couple of weeks and the remainder of 24. I'll certainly share my thoughts there too. And I think it should be a really good live stream with two YouTubers sharing their thoughts, taking on questions and answering questions. So I encourage you to join, check out the community page. I'm pretty sure it's there, and would love to see you there tomorrow. And then last thing is check out chart 7, please. You're bringing some very insightful information this week. So May 29th, okay. So chart 7. So unrealized gains, held maturity securities available to sell. Okay, so yeah, but there's one thing. So we're talking about unrealized gains potentially on their bond holdings, which could be a problem, but they are taking, so held to maturity securities available for sale securities. Okay, here they are. At the rate that interest rates have been dropping, a lot of these securities are gaining value now. Bonds are really adding value very fast because interest rates are dropping. So I think this is a really interesting chart, and I'm going to read this on my free time here. But keep that in mind that this could be a report that didn't age very well because very quickly interest rates have been falling. And that really does relieve a lot of the risk with long-term bonds and other types of assets that banks hold. So keep that in mind. Hopefully that's a tip that helps you as you look at that. So guys, thanks again for tuning in. Awesome session. Everybody enjoy your weekend and good luck investing. Take advantage of this market. Hopefully, companies that you really want to be a part of are being discounted and you can buy more shares and make lots of money over time. All right. Take care, everyone.